macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen. Time for a little technical analysis 101 now with Kevin Cook. Kevin is our senior stock strategist at Zacks.com. And it's been a while since you and I spoke here. It's great to have you back. And it's been a while since we've looked at the S&P chart together, you and I. But last week, I noticed you wrote a piece where you claim the index was going to trade between 1250 and 1350 until April.
Yeah.
And I was just wondering about your logic for that. And how does that all relate to this Golden Cross business that I've been reading about?
Good. Yeah, so I've been a bull since the October reversal rally that we got. And I've been calling for 1300 and now 1350 in the first quarter here. But we're definitely due for a pause. And so I see a range trade here till April between 1250 and 1350 for the following reasons. Look at what we have to get through on the top side. That you basically got what some technicians would call a head and shoulders top pattern there. And that's that curve. And that was basically the first half of 2011. So you're really looking at the 1350 area as being heavy resistance, a lot of supply there, a lot of willing sellers. I think we'll get through there this year and possibly see 1400 on the S&P, but it'll take several tries to get through that level. And then as far as pulling back to support, maybe down to the 1250 on the S&P, that was a significant level that we got through, and now it will become some support and there'll be some demand down there. And you mentioned the Golden Cross.
Yeah.
This is a weekly chart actually. So the moving averages I have on here are 10 and 40-week moving averages, which correlate to the 50 and 200 day. Pretty closely, close enough. So the weeklies actually crossed last week around 1255. The daily averages just crossed this week. But the point is that yes, it is bullish for the market. Should we rush in and buy the market now just because they crossed? Not necessarily. What you really need to pay attention to is, where was this picture 3 months ago, right? I was on CNBC early Monday morning and they asked me about this and I said, really, the buying opportunity was in October when the 50-day moving average turned up sharply, and you can see it on the chart here. And so it was sort of predictable, almost inevitable, that the 50 and 200-day would cross positive. So that's what we're experiencing now. I think that'll be a support area because it's a confluence of things happening there on the chart.
Okay.
So let me back up here a second and just talk about how I use technical analysis, and I think because then we'll come back to this chart. So this is TA 101 according to me, and so these are the things that I believe and the things that I find useful and that we've used here for 8 months to make some money. The chart is just a picture of market psychology or behavior. So what shows up? Emotions show up on the chart at extremes, right? Fear and greed, hope and despair, optimism and pessimism. And and what picture are we looking at? It's not you or I buying necessarily. It's the big institutions. It's trillions of dollars moving money in and out of stocks, and that's the picture we get. So, and I like to look at these things in terms of probability, not thinking that I have a crystal ball telling me which way the market is definitely going tomorrow or next week, but what are the likely odds? Maybe I'll say we've got a 65% chance we go higher off of this level. And that tells me how much I'll bet. Some old traders from the 60s, a guy named Ed Thorpe was actually a blackjack card counter. He came up with an approach called edge odds that told you how to bet in blackjack. He also became a hedge fund manager, Princeton Newport Partners, which had a 15% annual return for like 20 years.
That's
so
interesting.
he knew what he was doing. So that's where edge odds comes from. And it tells you, knowing how good your edge is and what you think your probability is, how much do you bet? You bet more, when it's in your favor. Price action. So I'm really looking at price action and not oscillators. You hear people talk about the MACD, stochastics, RSI. I don't care for any of that. I mean, I'll learn about it and people can tell me, oh, the RSI or the MACD is doing this, but I really don't pay attention to it. I never put it on charts. I just look at price action because it tells me what's going on.
And cards.
Yeah, exactly. And I use simple moving averages, not hard trend lines. You see guys drawing these hard trend lines, this is sloping down this way and this is coming up this way. I don't do that. I just use moving averages because they tell you more about trend and the power of a trend and the magnitude of it than anything else.
All right.
So markets trend in different time frames. I wrote here something called 3 cons. There are 3 words that start with CON that are of interest to me on a chart. I want to look for a consolidation pattern, where the market's congesting, and we have to figure out which way it's going to go, and then continuation. So these are things. This is more of a way of talking about the market's flavors, than pinpointing, this Fibonacci number or this, this is going to do this. You're looking at the patterns because markets do not trend all of the time, right? The markets may only trend 20% of the time, and the other 80% of the time they're in congestion, consolidation, or continuation pattern. And the last thing is, so here I am a technician, but fundamentals absolutely matter to me. Whether I'm looking at a company's earnings estimate revisions or an industry or the economy, because GDP is an input into valuation models by institutional fund managers. They have to say, well, how much do I think the economy is going to grow? If you're going top down, here's the economy. What's it going to do to this industry? What's it going to do to this stock? And so those are things I definitely look at. When I was a currency trader, there are so many fundamentals between two different countries, say Germany and Italy, or say Germany and Japan. At the border of two countries, right? GDP, interest rates, inflation, all this. No, I said I'm not smart enough to figure all that out. Because even if I was an economist, you could have 6 economists in a room with 12 opinions on where something's going to go. So I said that in currencies, price precedes fundamentals. The price action tells you what the market thinks of the fundamentals, and that is not as fully true in equities, but it is very true to a degree.
All right. Well, I'm glad you fleshed that out for us.
Okay.
Your terms and tools make them a little more understandable to our viewers. So take us back to that price chart and walk us through how this has worked since you and I first began discussing the S&P chart. I think it was last summer.
Right. So, we had that breakdown off of 1250 in the summer, and what did the market have to digest? It was fundamentally we were digesting recession fears and the European crisis. So, but at the time, you'll remember I said 1100 will be an extreme value area on the S&P 500, and that long-term investors definitely want to be buying near 1100. But we had to take the time to digest all that bad news and find out, were we headed to a recession, and how bad were the Europeans going to let their situation get? Were they going to have their version of our 2008?
Yeah.
So that's why we spent all that time from August through October, digesting that news. And so what I've written here is that 1225 was a level of supply, meaning we were below that, and the market had to fight to get through there. It tried to bump up through there in August, September, and October, and it finally did it after the October reversal bottom. So getting through 1225 was significant, then getting through 1250 was significant, and we had to digest more of that. So the market had to fight with those levels. So this may seem self-evident. I write the market had to fight through a level to gain higher ground. Well, that seems self-evident and almost redundant, but the point is that if the market is fighting to get up through a level, then it becomes significant when it does. And so that's why I said in October the market's just waiting to go higher. So we consolidated around 1200, then we consolidated around 1250. Now where are we at? We're not getting through 1350, I don't think, anytime soon. That's going to be resistance, and we're due for a pullback probably to 1250 sometime in the next month or two. And so that's why I'm saying we've got this trading range here till April.
All right. It seems like your best timing swings with your methods occur in a 2 to 3 month window. At least that's what it seems to me. So what's your best time frame for making these calls?
Yeah, so, that's probably where I'm at, is I am looking at 2 to 3 months, but I'm actually using multiple time frames, because I might be able to look at a weekly chart and say, this is where I think we're going to be 9 months from now. And so that colors my view of the next 2 to 3 months. And then in the short run, the short run is much harder to predict when you're just using a chart or even the fundamentals. But so if we are due for a pullback, say from 1325 back to 1275, I think that's a 50-50 gamble right now. And I think it's more certain that we'll go up to 1350 and come back down and have to digest around 1300. So really it's about using multiple time frames, and then investing accordingly. If you're if I said that 1100 was an extreme value area last fall, which I did, that was a place to put a lot of money down. Your edge odds there were great, and what did we do? The market built a base camp there essentially at at 1150. That's why when we came back down to 1150 in December, it was in November rather, it was very significant that the market bounced off of there. So that was further confirmation that the economy is sound enough, and there's plenty of buyers down below 1200. So that's why we'll continue to rally here. And I think right now we have to spend 2 months just digesting the gains around 1300.
All right, well, I have a feeling that you and I are going to be doing more chart talk going forward here. Kevin Cook can be followed if you would like to follow him in text format on our website, zacks.com. If you're not there already watching this video, his picture's right there on the website, and those articles change of his frequently throughout the trading week. And you can also follow him on Twitter at Kevin B. Cook. With Kevin, I'm Terry Ruffalo.